Hey everybody, Courtney Smith here with our Wall Street winners for May 17th. Pretty exciting, lots of action, that's for sure. Oh my God, this is really action oriented. All right, we had the sharp move down on expectations of higher inflation, which will happen and is happening as we speak. Inflation is coming back bigly. All right. So we are now in the first phase of the Biden boom bust cycle. I'll be focusing on this a lot in coming weeks of how to profit from it. First the boom, then the bust. We're in the boom phase right now. But part of the boom phase is inflation is coming back at levels we have not seen since the 1970s. And that's given the market some shaky days in the last week. But we closed strong at the end of the week, and I think we're going to continue, as I've been telling you for a long time. This is going to be a struggling bull market, and indeed the S&P struggled. Dow Jones, look at what happened here. Look at the box in the upper right-hand corner, and the red line shows selling pressure. It skyrocketed up. I'm going to come back to this in a minute. We also saw the green line go down. That's the buying pressure. But as we ended the week, we saw buying pressure slightly above selling pressure. But nonetheless, this is the biggest attack that the bears have run since really the end of February, early March. NASDAQ. This one, however, does look a bit sick, particularly when you first look at it. We clearly are making lower lows and lower highs. So we're still in the phase that we've been talking about for months. Literally, since the beginning of the year, I've been telling you, you want to be in Dow type stocks, S&P type stocks, not NASDAQ type stocks. Why? Because as interest rates are at zero, as the fiscal policy is wildly stimulative, as the monetary policy is wildly stimulative, that's going to help the economically and interest rate sensitive stocks which dominate the Dow and the S&P. Growth type stocks are in the NASDAQ. We don't want those. We need to be in a completely different sector. So after years of focusing on NASDAQ stocks, we've been focusing on Dow and S&P. However, there is a little bit of a light at the end of the tunnel here in the NASDAQ. Look over on the right-hand side and you see the purple predictor there. And the purple predictor is starting to get bullish. So we're going to we've seen the bottom, I think, here in the NASDAQ, and we'll start to climb up. But it's going to take a long time, as in months, before we see the NASDAQ climb to new all-time highs. But the Dow and the S&P, maybe this coming week or the week after. All right, we still have a buy signal on our seasonality for the stock market, and we're on a buy signal for the utilities as well. So both of those are in seasonally bullish mode, which means we put on extra large positions. Now here's the seasonality from Stock Traders Almanac, highly recommended, and it's basically saying things are going to be a little choppy this week. Little choppy, no big deal. Asset allocation continues to suck money out of the bond market and into the stock market. It's pretty steady, but nonetheless, still a bit of money is coming out of bonds and into stocks. And that, of course, is hurting the bond market and boosting the stock market, as you would anticipate. But this was an interesting one to me. The stock market risk indicator really took a dive, and we actually broke to new lows. So the market was saying, we don't want risky stocks, we want a lack of risk. And at the same time, they were taking money out of the bond market, they were putting it into less risky stocks rather than keeping it in the bond market, which of course is the least risky thing of all other than cash. So this is a real big change going on here. We need to monitor this very, very closely. Global shares, after making new all-time highs last week, we're starting to rally right back up again. These are also very economically sensitive, and they will actually, I think maybe global shares will outperform the U.S. shares. The yield curve remains very steady, nothing to talk about here. Bonds came under pressure. So, as you know, we've been bearish on bonds for a long time, and we made a lot of money on the short side in bonds, and we're putting in sell orders again to get short on the bonds. But you can see that they sold off. Well, why didn't they buy bonds if they were moving to less risky assets? Very intriguing question. Our bond key factors, all of them pointing up, telling us that we're going to have higher interest rates in the future, which means lower bonds. All of them are moving up. You got to be short bonds now. I think the new leg, let's go back to that chart. I think the new leg has started. We're now making lower highs and lower lows. I think we're going to break the lows that we made back in March. I think we might do it this week or the following week. Sometime in the next 2 weeks, we're going to get short and go make another bunch of money on the next leg down in this big bear market. This is the biggest bear market since about 1983. I know you remember it very, very well, but I certainly remember it as well. Okay, dollar under pressure. Now, the pressure is not so much against the yen, but against the euro. So that's another play that we're working on right now as well. But nonetheless, a weak dollar is bullish for gold. And we see gold in this kind of weak bull market. I want to get long gold. I want to get long gold. And we're starting to see areas where maybe I can get in as a low risk trade. But definitely we want to be on the long side of gold. Why? Because as interest rates stay near zero, short-term interest rates stay near zero, and inflation comes back, real interest rates are dropping like a rock right now, and that's super bullish for gold. Our gold key indicators are two bullish. They're not super bullish, but they're bullish, and one bearish. So still, the weight of evidence is on the side of the bulls in gold. So not looking for a big explosive bull market. We're not going to $10,000 an ounce anytime soon, but a nice grinding bull market. Crude oil kind of drifted sideways, but the IEA, which is a pretty credible organization that is looked at by governments and big oil companies and so on and so forth as pretty straight. They play it pretty straight. They came out and said that the demand, they knocked down the demand a little bit because of India's COVID problems, so India won't demand as much. But then they ended up by saying, you know what, demand's going to go down, but it's still going to be higher than supply. So still looking for a bull market here in crude oil, and you can see we've got it going. Bitcoin under pressure, a lot of pressure here. It looks to me like a lot of people were taking their money out. Well, first of all, there's the Elon Musk story. I'll let you Google it and find out. That's just like silliness. But the fact of the matter is, we broke the lows that we had made 2 weeks before. We're now making lower lows and lower highs. By definition, that's a bear market. So as you know, we've been out of Bitcoin for a while, and I don't really feel I want to get short, but if we break the lows that we made on Thursday, I think you got to get short on Bitcoin. Now, I don't really trade Bitcoin itself. I prefer the futures market because I can't get ripped off. I can't be hacked. So I feel much safer trading the futures contract than the actual Bitcoin itself. All right, freebies, thanks for coming by. Fully paid on members. Hang on just 1 second, and let's take a look at our trades and our more advanced indicators. All right, everybody. Talk to you next week.